technology improvements bring both environmental and economic impacts to our society, as well as gains to our society. He has extensive extension and teaching responsibilities and does a lot of work in commodity markets in that area, and is currently teaching grain merchandising in our agribusiness management program. So without further ado, I'd like to turn it over to Dr. Lee, and we welcome you to our program today. Thanks a lot, Seungki.
Thank you, Brent, Holly, and Janice for organizing the webinar series, and thank you everyone for attending my presentation. In this webinar, I'm going to talk about the commodity market outlook for 2022. Here is a brief overview of today's talk. I will talk about corn and soybean commodity markets in this presentation. To show the market outlook, I will start with price-related statistics, and then we will check the USDA what's their report updated last week. Specifically, as the supply side is static after harvest, I will focus on demand factors. After going through the outlook, we will check what kinds of wildcards would exist in the 2022 market, including input cost surge and trade issues. So let's talk about the cash prices first. The figure shows cash price trends for corn and soybean in the Toledo area of Northwest Ohio. I picked Toledo region because it is a good sample area having corn and soybean as main commodities. In fact, the national average of cash prices also showed almost identical shapes, but slightly higher prices. So this is kind of what we are seeing the market prices. The left y-axis indicates price label for corn, and right y-axis displays soybean price level. After the COVID rebound, we have been in a bullish market last year, and so far the strong price trend has continued. The soybean price is $15.21 per bushel, and the corn price is $5.84 per bushel based on the most recent data in the graph. There are several reasons explaining the trend. The first reason is the highest inflation rate in 40 years. So last month, the reported US inflation rate was 7.5%. Certainly the high commodity prices are affected by the extraordinary inflation rally. The second reason is the low beginning stock. Although we had a successful harvest last year, the low beginning stock looks like suppressing too much excess supply. Third, strong demand. Exports are still relatively high, and ethanol demand along with high gasoline prices also accounts for the price increase in corn. Since the cash price is composed of futures price and basis, let's check what the futures market look like. The two graphs show corn and soybean prices currently traded in the Chicago futures market. Here, the cash colored by gray indicates the national average price for each grain. So the prices slightly differ from what's shown in the previous slide. Consistent with the cash price trend, the series of futures prices are pretty strong. We see good futures prices in both corn and soybeans. In 21-22 season average futures price for corn is $6.43 per bushel, and for soybean is $15.62 per bushel. These are certainly outstanding price levels. In particular, 22-23 futures prices are also relatively high now. So at this point, it might be not a bad idea for farmers to sell some crops even before planting, using forward contracts as an aggressive price preemption for 22-23 season. Here is the basis map with the Ohio border as identified, denoted by a dotted line. As the basis reflects the regional value of commodities, it is important to focus on Ohio. reddish counties mean they have weaker bases, and the green to bluish counties stand for the region with a strengthening basis. Compared with other Midwest regions, Ohio counties show relatively strong bases for corn and soybean. However, someone actually trades grain may be more interested in intertemporal comparison through time series rather than interregional comparison, because what matters more is the basis and basis trend of where she or he lives. So as an example, let me show the basis trend of Toledo again in Northwest Ohio. The two graphs are basis trend for corn and soybean. If you are not in this region, just please take it with a grain of salt. And the 10-year average trend shows a typical pattern of major crop producing regions in the Midwest. That is a clear seasonal cycle relying on the harvest timing. So like you can see, when we look at the green line, there is kind of sudden drop after September, which is indicating the local supply upon the arrival of new crops. And compared with other years, the basis in this year, colored by green, seems pretty low. It can be understood by the local supply after massive harvest last year. And elaborating on some like eye-catching patterns in this graph is first the yellow line for 2018, which is always below the 10-year average. The weak basis was due to the trade war actually. And the sky blue line for 2019 shows strong basis even after harvest, which is also not very usual. And this was actually because of the prevented planting issue by weather. And lastly, the red line for 2021 shows a remarkable variability due to small stocks and COVID. Okay, now let's check the big overview of the use and supply for corn. This table is from the last week's USDA report, and the blue column is of our main interest. Specifically, as supply part is almost determined this year, I am focusing on demand categories. So for 21-22 market, USDA forecast the same level of total demand as last market year. Ethanol corn use accounts for the extra demand, whereas exports are adjusted down by 12%. So they kind of offset each other. And the season average price is $5.45 per bushel. Additionally, I added a column for 22-23 forecast by USDA. Of course, this is a little longer term projection, so it may not be very precise due to many uncertainty factors. But I just wanted to highlight a slight reduction in the planted area for corn, reflecting the high anhydrous ammonia price. And let's talk a little more about the details of each demand factor. The first item is the feed and residual use, which takes the largest portion of corn demand. The left graph shows 6-year historical feed use and this year's forecast. The feed demand looks stable, and USDA forecast the total use for feed and residual at 5.65 billion bushels this market year. I also see the range between 5.5 to 5.6 billion bushels as the most likely case. And in November Outlook conference last year, I predicted the first quarter feed use to be 2.45 billion bushels, and it turned out the actual feed demand was 5% higher than that. It might be a sign of strong feed demand or a preemptive move to secure corn due to uncertainty in the supply chain. My second and third quarter predictions are 1.4 billion bushels and 1 billion bushels respectively. Next, demand item is ethanol use, the second largest group. The graph illustrates the gasoline price trend and the portion of ethanol production to total gasoline demand. So, so the gasoline price shown in the gray line based on the left y-axis, and the ethanol production portion is drawn by the red line on the right y-axis. We have been at the highest gasoline price within the last 5 years. The high gasoline price incentivized to use of more corn for biofuel. Currently, about 12.6% of gasoline demand is covered by corn ethanol, even though the high production portion could be partially due to the seasonality. It looks pretty clear that there exists strong ethanol-induced corn demand. And the last major corn demand item is export. The left figure shows the cumulative export volume defined by the amount of shipped or committed corn. This year's corn export volume looks pretty good, showing a slight below of the last year's record. But of course, we have to keep in mind that the last year's record is really exceptionally high level. So at least as we are like expecting a close level to that, means we are still having a pretty strong demand from the exports. The current USDA projection for the total export volume is about 12% down from last year. That is compared to the blue line in the graph. And the right graph is drawn based on this year's current export record. So the bar chart shows the export volume shifts indexed by the left y-axis, and the denoted number near the bar mean the percentage change from February of the previous year. So kind of the year-to-year comparison. Blue dots represent export volume and are indexed by the right y-axis. So, so the listed countries are the top 6 US corn importers. The rank goes by 1 to 6 from left to right, as we can see from the blue dot levels. And the 6th bar, the 7th bar, unknown, is capturing export sales that are currently marked for unknown destinations. For example, a multinational company may purchase corn to be shipped in 3 months, but they are not sure whether they want the corn delivered to China, Korea, or Taiwan. In those cases, the sale is marked as unknown. One country that draws our attention is Canada, with an above 509% increase rate from a year ago. This exceptional increase is actually due to the severe drought last summer, which induced a humongous shortage in cattle feed in Canada. And another like eye-catching stuff is the biggest volume down in the unknown, and it is attributable to supply chain issues. So it is pretty kind of imaginable situation that people are afraid of this supply chain issues. So that's why this undesignated contracts are not made that frequently. That is kind of what you can imagine. Okay, let me move on to the soybean part. Similar to corn, I will focus on the demand side of soybean. Total soybean demand is projected to be decreased by 3% from last year. This drop is mainly due to the anticipated export drop. We'll check the details in the following slide. The season average price is anticipated $12.6 per bushel. And additionally, the planted acreage forecast might be worth checking at this point. USDA forecasts soybean planted acreage as 87.5 million acres, a slight up from last year. Honestly, my gut feeling says we should expect bigger changes in planted acres than USDA forecast. I mean, a larger drop in corn acreage than 1.5%, and greater soybean farmland than 87.5 million acres. That's like how I expect, what I expect. So here, the two graphs follow the same format as the corn export slide. From the left graph, we see the total soybean export volume, and it shows like pretty similar trajectory to the 5-year average so far. And the right figure helps us identify China as the main reason for dropping the export volume. Specifically, after the recovery from African swine fever, Chinese farmers actually have been experiencing falling the hog margins, and this decreased hog margin made farmers replace soybean with wheat and other cheaper grains. Here, like corn, unknown shows more than 50% drop compared to last year because of supply chain issues. So far, we have looked at how the current markets are doing, and now let's check what will be the wild cards in 2022. The first group is about potential challenges. I especially picked high input costs and margin squeeze as a first wild card. And second factor adding uncertainty is the expiration of US-China trade agreement phase 1. Since phase 1 ended last December, it is noteworthy to keep an eye on what will be on the table. I will mainly talk about these two items in the following slides for the potential challenges. Other potential challenges I picked are the ongoing supply chain issues, COVID-19, interest rate increase by Fed. Although we have made potential challenges, we have many potential challenges. I think still there is a bright spot in the market prospects. The silver lining I picked is the global competition and additional export opportunities. I will talk about the details soon. Lastly, in a longer term prospect, the renewable diesel push will possibly open a door of considerable demand for soybean producers in the next few years. Here, based on the USDA ERS farm income report, I made a graph showing gross farm income, total expenses, net farm income, and government direct payments. As a reference, I draw a line for the 5-year average of gross income and total expenses. We can see both gross income and total expenses are well above the average in the 21 and 22 forecast. Specifically for 2021, when compared with the previous year, due to the larger increase in gross income than total expenses, the net income is expected to ramp up more than 25%. In 2022, the forecast shows a greater increase in total expenses than the gross income, which will return about 4.5% smaller net farm income. Additionally, when you look at the government payment in yellow, it seems it is going down to converge back to the level before pandemic in 2022. So based on this graph, like although this is really an aggregate level like showcase of the farm income, like forecast, but we can see a signal of margin squeeze due to high input cost from this forecast. So now let's dive into the details of the increasing total expenses. So here, like I am trying to look at the sector-specific farm expenditures and how they are like expected to change along the this year and next year. The sector-specific expenditure shows which parts tend to become more expensive, and here the bar graphs show the level of sector-specific expenditure from 2020 through 2022 with indexed by the left y-axis, the $1 billion, and the line graphs show the percentage change from the previous year indexed by the right y-axis. And we can see the most sectors are showing a significant increase in expenditures, and the largest expenditure group, for example, the feed cost, is forecasted to keep increasing due to the high crop prices. And I want to highlight the fertilizer cost, which is pertinent to grain farmers. And based on the forecasts, the fertilizer cost shows the second highest increasing rate in 2021 and the highest increasing rate in 2022. So let's check what's happening in the fertilizer sector. So here I graphed product-specific fertilizer prices, and based on the biweekly, this was drawn based on the biweekly production cost report from USDA. All products are using the left y-axis, except for the diesel fuel in blue, which is indexed in the right y-axis because of the different scale. And since 2021, we can see all fertilizer prices have increased. Of course, the anhydrous ammonia in red is especially remarkable. 3 months ago in November, I mentioned a pessimistic prospect about ammonia prices. At that time, the ammonia price was slightly above $1,000 per ton, and that was already record high in 5 years. And unfortunately, the ammonia price has continued increasing during the last 3 months, reaching at about $1,500 per ton now. So considering this like really skyrocketing, sky high prices, the cost saving strategies become ever important for farmers this season. Specifically, in the aspect of farm management, I'd say soil tests and nitrogen rate adjustment would be very important. In the aspect of cost benefit analysis, I would pick, it would be useful to evaluate all feasible fertilizer options and to develop and compare enterprise budgets under different scenarios, so that which like decisions will be the most beneficial, like in terms of individual farmers' perspective. And here I did a small exercise by regressing ammonia price on the lagged prices of all fertilizer products and natural gas. The black line is the actual ammonia price, and the red line is my model prediction. So it seems the model explains pretty well about the ammonia price moves, including the recent drastic surge. Here's my 2 cents. I expect the ammonia price will not like keep increasing as much dramatic as before, but also will not like easily like and rapidly drop within next few weeks. So there are many factors that can affect the price move, and I would keep paying attention to 2 factors. First, the natural gas price, and second, the supply chain issues. Of course, the escalating tension in Ukraine also can be a game changer as well. In conclusion, I'd like to emphasize the merchandising strategies. Both cost saving and revenue improving efforts are needed at the same time. One example would be, as I mentioned before, preempting good sales opportunity would be a wise way to secure your revenue so that to protect your net margin in the end. So here, like another wild card I would talk, I want to talk about is the trade with China. As of January, phase 1 of US-China trade agreement has expired. There were a lot of news discussing the review of phase 1 and the possibility of phase 2. I don't think we will get to phase 2 of the trade agreement in the near future. Currently, the US is pushing China to complete the promised purchases first, and it is unlikely the second phase can be outlined before the two countries agree on how to handle the shortfall of phase 1 purchases. It looks like we have a long way to go to see the second trade deal if it exists. Here's what's happened during phase 1 in the agricultural sector. The charts are borrowed from the Peterson Institute for International Economics. Considering China purchased only 57% of total commitment for all goods, the ag sector had actually a much better trade flow, 83% realized purchase out of the total commitment. Of course, still there are about 17% shortfall of promised purchase though. For corn and soybean, we see quite different shapes. China purchased more than 10 times of the promised corn purchase, whereas soybean purchases only reached 66% of the target. This divergence is mainly grounded on China's domestic situation, actually. Then naturally we can ask, what can you expect for 2022 from China? And I brought corn and soybean forecast of Chinese agricultural supply and demand estimate. And I boldened the import rows because they are indicating potential opportunities for US grain sales. Because of the high domestic corn price in China, many Chinese farmers opted to plant corn last year. So due to the strong domestic supply, China is likely to significantly reduce corn imports this year. In contrast, soybean import from China is likely to increase by 2.2%. Of course, the import forecast does not necessarily and directly imply the sale of US grain, because we also have to think of what's happening in the global competition. And that is naturally, like, that is connected to actually the silver lining. Here, I expect there will be a silver lining for US farmers in the global competition. Due to the severe La Nina induced drought in Paraguay, southern Brazil, and parts of Argentina, soybean harvest in South America got critical damage. For instance, major ag companies in Paraguay reported the worst harvest in 2 decades. Brazil and Argentina also slashed their harvest forecast. So the supply reduction in global soybean market would give extra demand for US crops. And as we can see in the map, the Brazil and Argentina have pretty like long shave of landscape. So that's why, even though some like damage happened, but part of they still have pretty much of land that is not affected by this severe drought. But as we can see, Paraguay is really in the middle of the drought and didn't have enough like other farmland, other region to avoid this damage. So that's why they really got the kind of national damage in their crop production in this case. Here is the world corn production forecast. As U.S. farmers finished harvest already, there was no change from last month in U.S. corn production, of course. Compared with last month's forecast, Brazil's corn production is reduced based on low yield expectation for first crop corn. However, still major exporters are expected to show a significant production increase compared to last year. This is mainly because last year's corn harvest in Ukraine, Brazil was unusually low. And now soybean production. The world soybean totals forecast substantially adjusted down with the realized damages from South American weather extremes, about 2.3% down from last month. Particularly, the forecast tells us that the bumper crop from successful harvest in the U.S. will not fully replace the production shrinkage in South America. Additionally, as mentioned before, as many Chinese farmers planted corn instead of soybean, the soybean production in China is predicted to drop by 16%. So we can see like there is kind of some potential that like U.S. soybean will have extra demand given this like weather shock and some like quick changes in the predictions and forecast of the corn production in soybean production in South America. Here is the last slide to sum up. We are seeing a strong season average prices for both corn and soybean this season. The price is about 20% higher, and soybean price is about 17% higher than last year. Demand factors will be the key to the rest of this market year. USDA forecast shows corn demand will be the same as last year, and soybean demand will be 3% down from the previous year. Considering we had an exceptionally strong demand last year, still the demand looks pretty supportive. In the lower table, I listed several wildcards I mentioned. In the red box, I entered risk factors. Obviously, high input price and the margin squeeze threat will be the most concerning factor. And secondly, inflation and rate hikes can be another risk. This will be shown as a wave in the whole market, but the ripples will anyway affect the ag sector in the end. Third one is an ongoing supply chain issues, and the wild cards in the yellow box are more close to risky factors than opportunities. But as we do not have any clue of direct effect of them on market yet, I just put them in the uncertain group. So they are first the continuing pandemic, of course, and second, unresolved trade agreement with China, and third, weather in this coming farming season. And lastly, the opportunities are first, additional export possibility by filling in the reduced South American crops, and second, the biodiesel push that is likely to make an extra demand for soybean in the next few years. And finally, the graph shows the volatility index in the Chicago Board Options Exchange, CBOA. We can see the current level is still higher than the period average of US-China trade war. So as a final note, I'd recommend keep watching the moves of market to safely go through this volatile market. I think, yeah, that is the end of my slides.
Thanks, Seungki. That's fantastic. You know, I mean, the unfortunate part is that we can't have a nice round of applause from our audience, who I'm sure would join me in applauding you and thanking you for the excellent presentation. We got a lot of great questions from folks, and I wanted to sort of walk through them. Remind everybody online there that we're only able to, because we can't keep up with everything, and have people sort of ask questions, quote unquote, in person. We're asking everybody to put their questions in the Q&A. You can also put them in the chat or keep a track of them. Seungki and I will have a look at them and have a little conversation about them here. I guess, you know, Seungki, I wanted to start off with, I guess, the question on my mind, and it fits with some of the questions by Aria Rivera on there. And the issue is, you know, is some of this volatility in commodity markets, these rising prices and whatnot, is it mainly sort of a function of the pandemic and uncertainty of being able to get inputs into the market, the rise in the cost of some of the inputs that's purely a short-term phenomenon? Or is there something deeper going on? You know, in the early 2000s, when we had the big run up in prices in agricultural commodities, it seemed like that was really driven by, you know, a massive increase in demand. And we didn't see big increases in prices through the rest of the economy. It was really something that was focused on commodity markets mainly. But here, you know, we've got all these other things going on. So I guess the question is, you know, is this really just supply chain problems that are going to eventually go away and commodity markets are going to come back down to earth, or is this something deeper? Is there anything else going on that we should be really looking at?
Well, I think this is really like kind of complicatedly mixed, like between the supply chain issue with the pandemic as well. So that's why it's like hard to say this can be temporarily, because like, of course, I think one day supply chain issue will be resolved, but we already and people already learned this is pretty kind of risky at some moment, especially like this kind of unexpected global shock. So that's why we are kind of now trying to find another kind of equilibrium point of the supply chain map, which is not like fully depending on the free trade itself, but also kind of try to manage the risk as well at the same time. So considering that, even though supply chain is reserved in the future, still like that supply chain will not be the same as what we have been before. So that's why this may or may not be, but I don't think that is a temporary issue. So this shock will remain in the longer term as well, I guess.
Yeah, you know, that's fascinating. So, I mean, Aria raises an interesting question here about the role of infrastructure. That is, you know, there may be some hope in our, you know, by policymakers out there that there's this big infrastructure bill that's going to clean some things up in our sort of transportation pathways, and that'll sort of maybe help control some of this price stuff. But I guess what you're saying is it's great. It's nice to have that, right? The infrastructure obviously in many places needs to be improved, but that may not actually solve the longer term, you know, commodity price issues we're observing now.
Yeah. Oh, but yeah, it's so yeah. That part is like still like kind of black box. Like it is not that clear like what will happen, because the reorganization and like restructuring may be a good opportunity in some sense, but still like kind of also give some risk. So we don't know like that change will affect which sector in what way. So that's why like it is not very easy to say like this is a bright spot for ag industry. So may or may not be, I guess.
You know, Seungki's like a prize fighter. You know, he doesn't want to sort of be pinned down on any particular direction on these prices. I love it. I love it. You know, this is great. So on the question of the price effects, though, especially on fertilizer, I was noticing, I still got the slide up here from your fertilizer things that sort of intrigued me, that they were seeing some of the biggest increases in prices in the last few years. You know, is that going to affect yields in the US or anywhere else in the world? I guess they're probably a worldwide price increase, but or ultimately, I mean, your suggestion was as farmers should look carefully at what they're using for their inputs, right? And make a real cost benefit analysis of that now. And I mean, if they do start using less fertilizer, nitrogen or phosphorus, are we going to start to see some slowdown in yield growth as a result?
Possibly, I guess, because definitely this like lack of input, if farmers cannot secure the input enough, then definitely they cannot use the fertilizer enough, or they maybe end up having to reduce the fertilizer rate this farming season, and that will definitely affect the yield, of course. But this is not just a situation for US farmers, of course, and even maybe some developing countries farmers do not have enough budget to purchase fertilizer compared to US farmers. So I guess this shock will not just affecting the US farming this coming year, but also many other countries, because they are also having the same similar issue. And I could see many use like saying that developing countries like Brazil and Argentina farmers are giving up applying fertilizer just because of this like unaffordable, like prohibitive prices of fertilizer in their local market. So considering that, like, of course, the market is kind of that is another uncertainty factor for market. But kind of my advice, like doing the cost saving effort is, with the like under the worst case scenario, farmers need to prepare, okay, given the same condition, if the price is kind of same or even like going down, then what should I do? And to protect themselves, maybe to catch the current high price in the futures market by forward contract, that is kind of one strategy. Or maybe just reducing the cost so that the margin can be adjusted and cannot be like really disappeared by this high input cost. That is kind of my advice.
But I guess there's also not just the fertilizer price, but because so many farmers in the Midwest, now I want to come back to the international point you raised in a second, but this Midwestern issue is, I mean, so many people are using custom applicators, so that it's not just the rise in fertilizer prices, but it's the rise in labor prices that also would affect their ability to put on fertilizers, right? I mean, both of those things are going to have an impact.
Yeah, actually, like I didn't like explicitly mention the labor issue like in my slides, but definitely labor is another like very critical factor. And hopefully like Margaret like in like Jodorowsky, like she can cover this topic like in the later webinar series in this webinar. So yeah, but yeah, that is really, I think, some hard part, because anyway, US farmers will, I guess, like having I assume that having higher labor cost compared to other developing countries, like especially the competitors like in South America.
Yeah, so on that question of the international side with respect to the fertilizers, just following up there, so you showed, okay, so I study a lot of climate change stuff, and of course in the news, a lot of people worried about the coming climate crisis for the world to experience. And La Nina certainly isn't climate change. It's a shorter term phenomenon that influences crop yields in large parts of the world. But when we see huge reductions in yield in Latin America associated with La Nina, but we also see higher fertilizer prices, are those yield reductions entirely a function of sort of what's happened with the weather, or is there some element of what's happened also with farmers' fertilizer application decisions?
Well, the data and statistics don't tell the exact like kind of parameters and the correlation between them. But I guess, of course, the farming practice was affected by the supply chain issue and high input cost for even like Latin America farmers. So definitely, I think that should be taken into account. But at this moment, the weather shock is, I think, major factor. And the difference between the U.S. farmer and the Latin American, like for instance, Brazilian farmers are not like that much heavily relying on the high-end like seed technology, for instance. So one of the successful farming last season was actually picked by the seed innovations, which is kind of my major research interest. And for instance, drought-tolerant corn has been like introduced about 10 years ago, and that is kind of really, last year people are saying that the drought was supposed to affect a lot than what we sow actually. So, but people are just guessing that maybe drought-tolerant corn played a significant role reducing this like kind of drought condition in the especially Western Corn Belt states. So considering that, maybe the resilience between the two countries, I mean the Brazil and US, should be somewhat different, I guess. And that is kind of the main reason that how the weather extreme realized the damage in the crop production between these two countries.
Yeah, I like it. I mean, I basically, if I can sort of sum up in my own mind what you're saying, essentially in the long run, technology is going to help us a lot with respect to climate, but unfortunately, technology probably won't help us with respect to all these changing prices and everything like that, right?
Yeah,
we haven't figured that one out yet, have we?
That's like really like kind of complex.
So we'll always have plenty of food to eat, but we just may have to pay more for it sometimes than we do at other times. And that, I guess, is all of history too, right?
Yeah, that's true.
Yeah. Well, let's look at some of the trade issues. I mean, you had a nice discussion about trade in there, and I think this sort of, for some of us who are sort of outside the market looking in, we don't understand all the complexities of the deal with China or the complexities of the sort of international market. But Ian raised some interesting issues there about sort of questions about whether, I guess, as I read his question online there, it's about how much of this is sort of just market effects that are driving what's happened in terms of Chinese purchases, or rather than China suddenly really managing this question. I don't know, that's how I read his question. You might read it differently. You can look at it and see the same thing. And Ian, if I've gotten it wrong, and come back with another sort of question on there. But it just sounds like you're saying that there's really the market effects are what's driving what's happened, the result there, more than sort of any decisions that China has made. Am I right on that or wrong on that?
So here the management is that like kind of the government like manage the trade flow, you mean?
Yeah, I think that's what Ian's referring to. Yeah, he's suggesting they don't have a great ability to manage that. They have some ability, but not a perfect ability.
Yeah, but I think that is a really fair point. I also feel like just supply and demand is not like totally explaining the China's import flow, but it seems like at least people are like, because we don't know the internal decision in the Chinese, like the party. So just get like what we are like as an economist, what we are seeing is like, given the trade flow, how should we explain that? And that is just typically, I think. And so far, it seems the domestic issues are pretty well explained. The fluctuation of the China's imports. So that's why I just try to rely on that like observations. But of course, I believe there must be some like internal pressures like to push the import flow to be going somewhere. That is, of course, the government's efforts. And one thing I know about it is China also had some actually had some efforts on the soybean drive project or something like that. That is actually some government like driven projects to push farmers to plant more like soybeans to improve their food security, and because they are actually raising a lot of hogs, and to like protect their supply chain, the upper stream needs to be like solid, and that is usually the soybean production. And so that's why China has been like pushing that project for, I think, for 2 years or 3 years, like actively for the recent 3 years. And then so far still like it seems farmers are like shifting to the corn and soybean a lot. So that's why I'm thinking, okay, still like farmers are having some degree of freedom of choosing the two plants. So that's why in some sense true, but still like I think this the flow can be much explained by the domestic factors and the individual farmers' choices.
Well, yeah. So that and the evidence you had there that suggests that despite maybe a government push, potentially with some subsidies for more soybeans, there was a big increase in corn planting in China last year, I guess, right? Is that what your data was showing?
Yeah.
Yeah, it's interesting. So individuals are making choices that might not align with the, with the sort of trade I guess, the trade agreements in a sense, right? And what the government might have originally anticipated would happen in the future. Well, I guess we've learned that in the US as well, that people don't always behave as our government or our market prognostications would imagine that they should behave, I suppose. That's nothing new there, huh? Yeah, there were some questions on basis, and I got to admit that when we talk about basis, I get confused. So I'm just wondering if you could explain basis. Probably everybody out there understands it really well, but if you could just explain it just in general terms, what it is, and then sort of the specific question from Mario really was, is why is it so different between Ohio sort of and Iowa? It looked like it was really different in your figure.
Yeah.
Sort of what explains that? So there you go. That can help me a lot. I hope some other people get some benefit out of that as well.
Yeah. So yeah, this is kind of similar to my class situation. So
you can just think of me as someone in your class for sure.
So yeah. So first, the basis is defined by the cash price minus futures price. So if the local price is like much lower than the Chicago futures price, then we are seeing very weak basis. So for instance, we can understand in case of Iowa, they have really they had, I think, about 200 bushels per acre like last harvest. So that's why they really have a local excess supply compared to even Ohio. So that's why they have lower cash price compared to the Ohio or maybe any other region in the US. So that's why the basis was so different and much lower than other region. So this kind of really the basis is depending on the local situation. So that's why I first showed the map and showing the distribution of basis and then focused on one region, because people usually in one region trading the grain are more interested in what their basis will be moving rather than what's happening in the other states.
Is that driven at all? And this kind of goes to Subu's question in the chat to differences in production costs by region.
Oh, of course, yeah, production cost matters, but I don't think there is a huge difference within the Midwest, especially the central Corn Belt states. So, but of course, the local elevator storage amount and the transportation cost, and of course interest costs, those are kind of some major factors affecting that. So that is kind of explaining some of the discrepancies between the two different regions, I would say.
Interesting, yeah. Yeah, so that I appreciate your help on that in terms of basis, because that's always been something that's confused me, but you explain it in a way that even I can understand, and that's super helpful. So I appreciate that. There's a question that just came in from Adam in terms of, well, I'll just read the question directly because I think it's interesting to think about. Do you have any guidance on time frame in 2022 to contract 2022 crops? Prices are high now, or they continue to climb? So that's a pretty specific question. They're looking for the big pow at the end of this. Where are we going to go? I'm looking at your picture here on uncertainty. Are you on the upside of that red line, or the bottom side of that red line? Which part of the two are you?
Oh, this is really kind of, I have to maybe, yeah.
You can put one hand behind your back too. No one can see that. You can do that. You just say on the one hand it's this, on the other hand it could be that.
Yeah, because I didn't explicitly mention last November, but my gut feeling at that time was actually the at that time the futures price will be kind of the highest price already. So I suspected this can be continued, but that happened and even increased. So you should take it grain with a salt, because my prediction is also not very precise at this moment. But still, at this moment, I see this is really a high price and exceptionally high price. So I'm skeptical of this high prices can continue for both corn and soybean. So that's why actually I kind of suggested selling grain at this time, even by the forward contract, may not be a bad idea. So that's why I suggested that. So if I have to pick up or down, then I would just bet on the down.
Sorry, I have my mute on there. Yeah, so that's interesting. So you're thinking that prices basically probably will head down, and we're looking at pretty good future pricing right now for the future. Yeah, that's good. People take that into account when you're thinking about what to do this year.
Yeah, and adding one more like sentence, then of course futures price can increase, but anyway, at this moment, farmers have pretty like good sense of what would be the farming costs like this the coming season, and then at least if they can like fix this good price, then that can be a good reference point so that they can adjust their input costs to like protect their margins. So that's why actually I am like kind of suggesting this, like making this suggestion.
Yeah, not to put a future plug in, but I'll be talking about energy prices in a few months, which is going to be beyond the point when people have to make some of these decisions about input costs, right? So you're thinking about energy costs this coming season is that we have a pretty good idea where they're going to be for the season right now. Is that kind of what you're saying, or are you saying, you know, that's the one cautionary point in terms of, you know, making your projection about what your, you know, if you use today's future price as your, you know, as your selling point, right? You know what your energy and your other input costs are. I mean, how well do we know those for the season now? I guess that's my question.
Well, still like we have like farmers usually have their own experience of like how much they like used to use for the input cost for the specific, and of course energy cost and these fluctuations will affect their like this farming season costs, but still like they know like how much they can save or how much they can adjust something like even though with the high prices. So that's why I'm suggesting that. But of course, like if energy price goes really like go high, like exceptionally, then that can definitely affect and that can harm the margin in the end, even though they are like securing the futures prices. So the hedging is kind of some limitations, but I think still effective for farmers in many sense.
Well, that's great. Well, Seungki, we've you know, wasted an entire hour here, and it's been an awesome hour. I really appreciate it. It's a fantastic presentation, and I really personally enjoyed the discussion. I learned a lot from your answers on all these questions raised by so many people who are really putting a lot of thought into these issues. So appreciate you coming today. Thank all the attendees for joining us. We'll encourage folks to feel free to go and review the webinar online, review the earlier webinar by Zoe a couple of weeks ago, which is online as well. And then to join us at our next webinar, I don't have the date, I'm sorry, but we'll be sure that you all see the date when we send it out in a little bit. But it's Ian Sheldon in March. We'll be talking about trade issues. We already brought some of those questions up, but we're going to move right into that critical issue for obviously commodity markets, but also a critical issue for, you know, a lot of other sort of things that we buy and sell in the US. So we'll talk about trade next. After that, we'll talk about the general economy with Mark Partridge in April. In May, we'll have Margaret Jodlowski talking about labor markets and myself on energy in June. So thanks again, Seungki. Appreciate it, and have a great day, everybody.
Thank you very much, Brent.